Now to the markets, the major averages are recovering from Thursday's sell-off, with the Dow, S&P, and the Nasdaq each trading about 1% higher today. But all three indices, they're still on track for weekly losses, along with the Russell 2000, which is on pace to end the week down nearly 3%. Joining us now on set to discuss his thoughts on today's rebound is the CIO of Pence Capital Management, Dryden Pence. Dryden, thanks for being with us in person as well.
Absolutely. Happy to be here.
What's moving markets? There were so many Fed speakers this week, so the focus was on that rate cut trajectory. But at the same time, we've been seeing commodities tick higher, maybe suggesting that geopolitics is driving markets. And we've seen gold again at record highs. So what is that in your opinion?
Well, it is a combination of a bunch of things, but and everybody's kind of dancing on the head of the Fed's pen, and I think we've got to move to that moment, or we're beginning to move to that moment, where good news is good news. So yesterday you had this, okay, wait, maybe we were going to have to move the rate cuts, and information and things like that are coming in, and where is this going to? Is it going to June, July? Is it going to be 3 or 2? But now what we are seeing is on this jobs number, is that the economy is good, and it's growing, and it's continuing to do so, and we're reaching that moment where for a long time good news was bad news. Now we're moving to, I think, where this recovery today is good news is good news. Yes, we've got some geopolitical risk. It's going to affect oil prices. You're going to see some tick up. We're north of 80 again. You're going to see some tick up in oil prices. That's going to push that inflation number a little bit. But I think that all of those things are just going to move this Fed period out, and we're going to, again, get to this point. Earnings are going to be coming records. I think we're going to see record earnings coming off of the first quarter, and that's good for companies. That's good for profits.
That's what I was going to ask you. I mean, because basically the stock market is discounting future earnings. What do you see there in the first quarter and for the rest of this year?
Well, I think what happened is everybody lowered expectations. At first, at the beginning of the year, they thought we were going to have around 7% earnings growth.
Now it's coming down.
Everybody's going to beat. Well, not everybody, but the majority of it is going to be major earnings beats. We're going to have a good first quarter. And this is, a number of consecutive quarters where you have 70 or 80% of the companies beating on earnings expectations. And now that the people, CFOs now know the terminal interest rate, it's probably not going to go higher than 5.5%. You're going to see margin expansion of these companies because, companies can plan now. I think we're going to see this broadening out of the 493. The rally is kind of the rest of the market rally is the way I would look at it as we get into the rest of the year.
The 493. That's
exactly.
That's not an area code. That's
the X-Mag 7, right?
Yeah, the X-Mag 7. Mag 7 are still going to do fine, but I think what you're going to see is this broadening out of the outperformance of the market. Earnings expectations were lowered, so everybody is going to beat. CFOs can now predict their margins. If we do get a lower interest rate coming in at the back of the year, that's going to provide some margin expansion. So we think it's pretty darn good across the board.
So what do you do with the Mag 7, the mega caps for the rest of the year? Meta's up 8% this week alone. So when we say that it's not the Mag 7, it still is kind of the Fab 4, if you want to call it, or even just some of these individual names.
Well, I think what happens here, it depends on if you're an asset allocator, you take a good look at your portfolio. You've done very well with the Fab 4, and you probably reallocate a little bit to small caps, industrials, companies that make things. Because I think that they're going to begin to see this, as I said, the 493 of the expansion of earnings beats first quarter, second quarter, third quarter of this year. And I think that you're going to find some good opportunities for performance in that part of the market.
Interesting. So what about bonds at this, and particularly munis?
Well, in terms of the muni market, we tend to like that. We think that there's really good opportunities there. But I think the bond market's got to be careful with. Everyone who is expecting going into this year, yay, we're going to have 6 rate cuts, are massively disappointed. We think that rates are going to stay very elevated in terms of higher for longer. So if you're expecting to make money on a falling interest rate market, that's not where to be. But if you're expecting to accrue income, and for a lot of retirees, they want the tax benefits of munis, then that's a good place to be, because we're still fairly short, but I think you can extend this period of time of higher interest rates out for a while, and that's going to be good for people. I mean, now bonds are back. We had that conversation a couple of months ago, and now that the muni market is there, you're going to see people. The risk-free rates of return are higher. The muni market's higher. It's a good place for folks who are just really focused on how can I get some tax-free income. They're going to continue to be supportive in that market.